All right. Today is Sunday, July 11th. This is a recap for the stock market activities last week and an outlook for the week to come. In reading the tea leaves during the last video, Thursday's video to be exact, this is what I said. So let's attempt and read the tea leaves here. If the US dollar is topping and gold showing a sign, at least from today's activities, that the bounce from the Fibonacci retracement level of about 1,760 is perhaps coming to a stop. Why would it come to a stop if the US dollar is topping? Well, there is the other correlation, the inverse correlation, remember, with the 10-year yield. So is gold predicting that we're seeing a bottom in yields? This is at least my reading from the charts right now. My call here, looking at the US dollar, looking at gold, is we have a bottom in yields. Whether it is a short-term bottom, a long-term bottom, who knows? But in the meantime, I am seeing a bottom in yields, and that in turn will be good for metals, specifically copper, some of the inflationary names, financials, regional banks, etc., etc. And indeed, the US dollar topped, and we saw gold trading flat, yields bottoming, and all of this technical dynamic allowed the reinflationary trade to bounce along with commodities during Friday's session. And the big question is the move we saw on Friday sustainable or not? But first, let's address the big question. Hey Maverick, on Wednesday, you said that the market is showing bearish signals and it is cracking. And indeed, on Thursday, we saw a massive flush down. And then the very next day, you said that the market, specifically the reinflationary trade along with commodities, will rebound. So what's going on here? Are we seeing bearish signals and cracks as you said on Wednesday? Or is the market going to rebound as you said on Thursday? What's going on here? You're flip-flopping worse than Kramer. Hold your horses. This is exactly what I said. The market is supremely tied to the technicals right now. Reading the technicals day by day is an extremely difficult job, but I'm putting my detective hat on and I'm reading the market's technical signals day by day. Now, every day, the market speaks to us, and it is up to us to decode the message, hear and understand what the market is trying to say or not. On Wednesday, we knew the technical setup. The market was rallying impulsively higher, gapping higher pretty much every single day. Overnight, on very low volume, the market was led by options trading, just like we saw back in August 2020. The technical indicators were extremely overextended, at least in the Nasdaq. And we said that we are looking for a top. We are looking for a reversal signal. In this kind of setup, any upset news to the market, whether actual news or any technical move regarding the bonds market, regarding a single stock, will open the floodgates to the downside because the market is overheated and overextended. On Wednesday, we got the signal, at least in the Nasdaq, the bear flag signal that played to the downside, and indeed it has done technical damage. It has broken the bullish trend the market has been on. So this is not just a one-day wonder, but you have to read the market's technicals day by day. On Thursday, the market flushed down, but it managed to rebound, closing well above the lows. In reading the market that day, specifically the US dollar, gold, and yields, the technical signal and setup from that particular day was indicating a rebound in the market, but specifically in commodities and the reinflationary trade. The question is, what now? What do we do from here? Do we go back to the reinflationary trade, perhaps shorting tech? I got the question on Twitter, and the answer was no. Yes, the reinflationary trade might bounce, but shorting tech is a no-go for now. And the reason is yields are still too low. At 1.3, 1.4, these readings are still favorable for technology and growth to continue to rally. So if we see yields continue to climb higher, perhaps reclaiming 1.4, 1.45 basis points all the way to 150, this could be a golden environment for the market to rebound higher, to continue on the rebound higher. SPY, the Qs, the IWM, but the main point remains the following. Perhaps the action that we got on Thursday, the flush down, was needed to address the concerns out of the bond market. The bond market has been saying there's something wrong here. The bond market has been screaming and yelling there is something wrong here. There is a massive deaccelerating of growth coming, and we saw yields dropping off the face of the earth. In the beginning, we said this is due to the taper tantrum, but the Fed did a 180, reassuring the market that they will not taper as soon as they said. Perhaps the bond market did not believe the 180 reversal. Okay, but now yields are dropping below 1.5, 1.45, all the way to 1.3. There's something bigger than just a taper tantrum. And we said perhaps this is the technicals, the short covering in the TLT. And this is indeed a plausible explanation. But another explanation that gained a lot of ground last week is Delta concerns, the new COVID-19 variant. When the market flushed down on Thursday, we were forced to address these Delta concerns. And I think the market looked at the same data I shared with you, that the current vaccines remain effective in terms of preventing hospitalizations and death. And this is what is needed to prevent any fresh round of lockdowns and shutting down economies. Certain countries are shutting down, but they have a poor record of vaccination. In addition, during the flush down on Thursday, Pfizer came out and said, you know what? We're going to produce a booster shot that addresses the Delta variant in particular. And in my opinion, that was good enough in addressing the bond market's concerns regarding Delta. And now the focus will shift from Delta concerns to inflation concerns, because this upcoming week we have a massive slew of macroeconomics data regarding inflation. So the bond market will start to react differently this upcoming week. The focus is not going to be on Delta or short covering or even the technicals. We will move to the fundamentals and the flow of news. So the technical damage is done in certain charts. It is not a massive technical damage, at least from a daily chart perspective in the SPY and the Qs. But we know that the market is extremely vulnerable to any upsetting news. And in this case, the NASDAQ in particular, because the NASDAQ is overextended. And if we get hotter inflation data this upcoming week, you will see the NASDAQ reversing quickly. Think about it for a minute. Let's say that the CPI number and the PPI and all of the inflation data we're about to receive this upcoming week actually come out cooler than expected, meaning that inflation is cooling down and the Fed's transitory argument starts to gain ground. This is, of course, hypothetically speaking, but let's say that happens. Will it allow the NASDAQ to rally higher? The answer is the likelihood, not really, because the NASDAQ has been rallying ahead of that news if it happens. So the likelihood is we will see a sell the news phenomenon. Now, what is the opposite scenario? Let's say the inflation data comes out too hot, indicating that inflation is rising way beyond control, and this so-called transitory argument will start to lose ground, because the transitory argument is based on base effects. Well, now we're going to get readings from June, and next month we're going to get readings from July. Base effects, when you pin the number from this year to last year, it will indeed look exaggerated, and the reason is last year the economy was under a shutdown, a very rapid severe shutdown, so the gap between the numbers will make inflation look worse than it really is. This is the transitory argument, of course. But if we start to head into June, July, this is when the economy started to recover and pick up quickly. If these numbers come out hot, then the transitory argument goes out of the window, because inflation is rising higher regardless of the base effects. And this makes this week extremely critical for the market. Absent of news, we will lead by the technicals coming out of the bond market, the charts, the options market. But now we're going back to the fundamentals leading the market once again. So I hope that this is clear for everybody. There is some technical damage in the charts. The markets are extremely vulnerable at this point, but you have to remember that we are in a bipolar market that rewards one side and punishes the other. In rare scenarios, we see the market rallying altogether, the reinflationary, the disinflationary trade, or dropping altogether. But these have been rare occasions, at least since March of last year. And this dynamic will not change until the monetary policy changes. And for now, we can guesstimate when the monetary policy will start to change, perhaps in the fourth quarter of this year. But for now, this remains a guesstimation, and the policy remains the same, meaning that the bipolar market will continue. Anyhow, before we move on and cover the market, how about you show me some love and press that like button? Consider it exercise for your fingers, because God forbid you move your fingers just a little bit and press the like button. It's too hard, right? We have regular 4,000 viewers, at least regular viewers. 4,000. Only 10% of you press the like button, as if it requires a lot of effort. You know how the algorithms work. You gotta press that like button for the videos to show up in recommendations and for the channel to grow. I'm going back to the office in September. This channel better start growing right now. So do me a favor and press the like button, or otherwise I will find you and you know what will happen to you. Anyhow, we got a market to cover, and here we go. The Dow Industrial Average closing in the green by 448.23 points, or a gain of 1.30%. The Nasdaq also closing in the green by about 142.13 points, or a gain of 0.98%. The S&P 500 also closing in the green by 48.73 points, or a gain of 1.13%. What about the sector's performance on Friday? We saw a rebound in the reinflationary trade as expected, therefore leading the market on Friday and capturing the gold medal materials. At number 2 for the silver, financials. At number 3 for the bronze, the stealth rally in real estate. We're not going to shame any sector here because every single sector of the market managed to close in the green on Friday. However, when we contrast this picture with the weekly picture, finishing at number 1, capturing the gold medal, real estate. At number 2 for the silver, technology. To number 3 for the bronze, materials. What about the laggards for the week? They're led by energy. We saw a massive flush in energy due to the OPEC confrontation. Mind you that crude oil prices actually finished the week slightly to the downside. Meanwhile, energy stocks finished with severe losses for the week. And therefore, pay attention here. If you're going to buy Exxon or Chevron, don't expect a lot of gains from the rally in energy. And therefore, in my own portfolio, I only own one stock, one oil stock. And this is BP, British Petroleum. But I also own other oil plays. For example, I buy crude oil futures. I'm invested in the Saudi ETF, ticker KSA. I'm invested in the Russian ETF, ticker RSX. All of these economies are highly dependent on crude oil prices, and they will move higher along with the rise in crude oil prices. But oil stocks, they have their own dynamics, so please differentiate between the performance of oil stocks and crude oil futures. Another way you can play this is by buying gasoline futures. They're pretty much going higher in a vertical line with no stop and sign. But oil stocks, a little tricky. What about the advance to decline ratio? It has been awful throughout the week, but on Friday we saw a rebound because a rebound was expected. Do we take the rebound for real, that it is sustainable? Not this guy you're listening to. I believe that we will go back to this bipolar market dynamics. But anyhow, on Friday, the market breadth was excellent. The NYSE closing with 87% advancing versus 10% declining. The Nasdaq 77% advancing versus 19% declining. Moving on to futures, we talked about the US dollar topping on Thursday. That indeed happened on Friday's session, and that allowed futures in general to trade higher. And by the way, you don't have to trade futures specifically, meaning the contracts. There are many commodities ETFs that you could buy, and these ETFs and indices managed to close in the green decisively on Friday. We saw massive gains for crude oil, gasoline, ethanol, up big on Friday by the tune of over 5.5%. And then softs, we talked about coca reaching 8-month lows. What do you know? It rebounded slightly higher on Friday. Likewise, we saw a rebound in cotton futures. Meanwhile, modest losses for lumber, sugar, coffee, and OJ futures. But the real action happened in metals because when the Dixie reverses to the downside, this is a catalyst for metals, but specifically copper, to rally higher. And again, you could play this by a stock called Freeport McMoran, FCX. Is it bottoming now that the US dollar is topping? This is at least my bet because on Thursday I sold a bunch of put contracts on my FCX shares. Copper closing in the green by about 2%. Likewise, platinum closing with massive gains on Friday, while we saw modest gains for gold, silver, and palladium futures. What about meats? Lean hogs rebounding once again. Perhaps lean hogs futures are bottoming. So here we go, lean hogs, aka the new big tech. Another rally on the horizon could be. Likewise, we saw feeder cattle futures also trading higher. Meanwhile, live cattle futures lagged for the day. What about grains? We talked about corn. That's a no-go. You abandon corn. The supply is going to come out hot out of China, out of the US. Forget about it. Corn is done. What we're concentrating on right now is soybeans and oats, but specifically soybean oil. This is my pick, along with oats. And both of these closing significantly in the green on Friday. We saw modest losses for soybean meal and wheat futures. Meanwhile, positive activities for soybeans, rough rice, and canola futures. And by the way, unfortunately, Finvits, they got a problem with updating their canola futures prices. It's been stuck at $7.99 for days now. But the reality is, canola futures all trading in the green on Friday, with sizable gains, by the way. Whether it is the current July contract, November contract, all the way to 2022 contracts, all rising higher. Moving on to the big casino, the options market. Let's see what happened on Friday. Here it is. Apple still at number one, the hottest stable in the market right now, with about 2.7 million contracts exchanging hands on Friday. About 80% of those were calls. They continue to bid Apple higher via call options ahead of earnings. Either they know something that we don't know regarding perhaps an announcement from the iMob regarding the iCar, or perhaps new colors that will take the stock higher, or they're speculating, they're betting the price higher ahead of the news, and this is always a recipe for a disaster. When the news actually come out, we see the sell the news phenomena, meaning earnings come out, even if they are impressive, the stock is already trading at all-time highs, and we see it flush down as all of these contracts, all of these options get closed. So be careful when you see a stock riding higher solely based on the options market activities. What about Tesla at number 2 with about 1.1 million contracts? About 55.5% of those were calls. And throughout the week, we've been seeing increasing bearish activities against Tesla. We will see if these bears are vindicated or not, because yes, there are some technical setups, and we will talk about the charts in a minute, but there are some technical signals suggesting that Tesla will suffer a lot of pain. We will see. What about number 3, AMC? We're expecting a gamma squeeze on Friday. That did not happen, and the options volume actually went down to about 740,000 contracts. About 61% of those were calls. It's not the end of the world for AMC because it remains supported by the options market. The put-to-call ratio remains supportive for AMC. The volume itself remains elevated from normal levels, indicating that the stock is still being supported, whether it is by the hedges, the apes, or both. But this upcoming week will be extremely critical for AMC because a lot of bids before the squeeze even started. A lot of these options bids were set to expire during July's monthly expiration, which is coming up this upcoming Friday. So this week will be extremely important for this stock in particular. And you have to go back and look at all of the options volume and call to put activities, at least for 2 months going back for the July 16th expiration. I don't have the time to do all of this analysis for you, but perhaps some of the apes who are highly committed to the stock should do this analysis. And you should find out whether the contracts both for July's expiration got closed, meaning we saw profit taking in these contracts. And if this is the case, then the likelihood is the market maker will decide not to buy the stock because those contracts are already closed, profits already made and taken off the table. We will see market makers dumping the stock rather than buying it. But if you find out that there are certain contracts very close to the money and the open interest continued to increase higher, leading to July 16th, then perhaps the market maker will be forced to buy the stock to deliver these shares. Before we move on to the unusual activities on Friday, let's get an update for the massive monster trade for the SPXU, which was initiated on Wednesday, and we saw the SPY dropping significantly down on Thursday. The trade was for the 17 calls, and the expiration date is July 17th. Somebody on Wednesday bought over 40,000 contracts, and the SPXU in this case is an inverse index of the SPY, meaning it appreciates in value as the SPY drops in value, and it is highly levered 3 times, meaning the SPY drops 1% and you see the SPXU climbing by 3% higher. But remember, it is not just that simple when we talk about highly levered ETFs. Both the bullish and the inverse ETFs, and I made a whole video about using those ETFs. I highly recommend that you watch that video because the last thing you want to see is yourself holding the bag in one of these inverse ETFs because they're designed to lose value over time. So if your timing is wrong and you find yourself holding the bag in one of these inverse indices, you will suffer an insane amount of pain. So please watch that video before you get involved in trading these levered ETFs. But in this case, this trader is a very experienced trader. We talked about this particular trader. We described him as a whale, and this whale bought over 40,000 contracts, specifically the 17 calls expiring this upcoming Friday before the flush down. And in my opinion, this particular trader closed at least half of his or her position right after the drop on Thursday. So they were looking for quick gain. They read the market's technicals just like I did. The only difference is they, meaning the whale, managed to make money by putting their money where their mouth is. And this guy you're listening to did not put a lot of money where his mouth is. So the whale made a lot of money and the non-whale made a tiny bit of money. And of course, they're saying this is a famous options trader by the name of 50 Cent because he buys these options priced at 50 cents and he goes in and out quickly, making a massive insane amount of gains. Who knows who was actually behind the trade, but they are professionals, they are experienced, and in my opinion, they took profits off the table right away. Those options quickly doubled in value, they cashed in, and they're perhaps leaving some house money on the table, but the majority of gains were already cashed out. Now, there is another trader called the Apple Farm. And Apple Farm is called that name because they sell an insane amount of Apple call options from time to time. And usually, not always, but usually, when Apple Farm starts to sell an insane amount of call options on Apple, it is usually the indicator of a top in Apple stock. So continue to watch that call options volume on Apple. If we see massive trades of selling an insane amount of way out of the money call options in Apple, understand that Apple Farm is calling a top on Apple. Of course, the identity of Mr. Apple Farm remains unknown. And here it is, the unusual trades on Friday. Starting with the ticker PDD for Pinduoduo. Now, all of these Chinese names got whacked severely this week. Course, on the heels of China cracking down against Didi. In other words, punishing Didi for doing an IPO in New York. And Chinese stocks went down along with Didi. But are we starting to see some short covering, shorts taking profits off the table, perhaps reversing the trend for the Chinese names? We saw that happens on Friday. Whether that is sustainable or not, that remains to be seen. But at least this trader is betting that the rebound will continue at least for another week in these Chinese names because they bought the 118 calls, expiration date this upcoming Friday, July 16th. With expectations that the name Pinduoduo will rise by over 6% by then, and they paid about 90 cents a piece to enter this trade. All in all, bringing the total to about $1.5 million. What about the trade for the ticker AAPL, Apple? Here it is. Is this Apple Farm or what? We don't know. But in this case, somebody bought the 152.5 calls. Expiration date, July 23rd. So in 2 weeks, they're buying and somebody else is selling those calls. Remember, we're heading into earnings season. We're going to hear from Apple very soon. They're expecting, the buyer at least, they're expecting Apple to rally by over 5% by then, and they paid about 65 cents a piece to enter this trade. All in all, bringing the total to about $600,000. What about the trade for the ticker UDOW? This is yet again a levered index, a levered ETF, 3 times, but this time this is a bullish ETF, not an inverse ETF, meaning that it rises higher as long as the Dow rises higher. The difference is the UDOW gains 3 times what the Dow gains. But remember, there are a lot of donkeys on TikTok and the likes, the Robin Hoodiots, who made a suggestion to buy these ETFs, whether it is the UDOW or the TQQQs, because you will triple your gains, bro. You will make 3 times what the market makes. False. Wrong information. Please watch the video regarding inverse indices that I talked about before, because I talk about this fallacy that the 3 times levered bullish indices gain 3 times what the market gains. They do in a single day, but not beyond that. Meaning, if the SPY finishes the year with gains of about 5%, the bullish levered index 3 times, in this case, the ticker is SPXL. It doesn't mean that the SPXL will close the year with gains of 15%. Matter of fact, it could actually close the year below 5% gains that the SPY scored. So please understand how these levered indices are designed. And if you're not familiar 100% of how they're used, avoid them entirely. Whether buying them as a stock or trading options on them. Avoid that entirely. Because 90% of the time, you're going to lose money trading these levered ETFs, unless your timing is 100% right. Regardless, we have somebody with high conviction here because they're buying the $80 calls on the UDOW with the expiration date of September 17th. They're expecting the UDOW to rise by over 6%. They were willing to pay $3.30 a piece to enter this trade. All in all, spending about $2.3 million for this trade alone. Another way to read the trade is the following. This is somebody who's betting that the industrials, the cyclical part of the market, will continue to lead all the way till September. What about the trade for the ticker XOP? This is the oil and energy ETF. They're buying the 101 calls, expiration date July 30th, with expectations that the XOP will gain over 7.5% by then. They paid about $1.50 a piece to enter this trade. All in all, bringing the total to about $1 million. What about the trade for the ticker SNOW, Snowflake? We saw a lot of call options buying for this name this week. What is the reason behind that? Who knows? But my reading is, once we heard the news regarding the JEDI contract, that the Pentagon is ditching Microsoft, that opened the way for speculation on which company will gain the contract. We know it's going to be Amazon, but yet again, it opens the door for speculation. When we see speculation, we saw a lot of opportunities for gains to be made in the market. We saw cloud names like Oracle, SAP, Snowflake, ServiceNow gaining significantly this week, even though the likelihood is they're not going to win the contract. But regardless, we saw a lot of call options buying, triggering a gamma squeeze in these names, and somebody's betting for more gains to come, at least for Snowflake, because they bought the 300 calls, expiration date July 23rd, with expectations that Snowflake will rise an additional 11% or more by the expiration date, and they paid about $2.55 a piece to enter this trade. All in all, bringing the total to about $1.4 million. Continuing with interesting trades in the options market on Friday. What about the trades for the ticker QQQs, the NASDAQ? Pay attention here because this is a calendar put trade, meaning they're betting for a decline to come, a correction on the NASDAQ. But they want to minimize the risk here by doing 2 things: reducing the entry cost and buying themselves more time for the trade to work. And calendar calls and puts are my favorite trades. I love them. They're smart and they often result in a lot of gains. And if the trade goes the other way, your hedging techniques by opening a calendar trade will prevent you from suffering a lot of losses. In this case, the trade is for the 333 puts. They bought the July 30th expiration and they paid about $1 a piece for the trade. And then they sold the same put, 333, with the expiration date of July 23rd, a week before that. And they collected about 50 cents a piece from doing so. All in all, that reduced the entry cost to 50 cents a piece. All in all, the total spent for this trade is about $250,000. of $1 million. Now, they're expecting the Qs to suffer a correction of over 7%, but they're not sure if it happens a week from now, 2 weeks from now, and therefore they're giving themselves all the way to July 30th. And the trader here doesn't believe that the Qs will suffer a correction of over 7% by July 23rd. But perhaps by July 30th, meaning that the Qs will decline, say, 5% by July 23rd. And that decline could continue all the way to the next week of July 30th, and we indeed see the Qs correcting by more than 7%. Either way, if the Qs go down but not below 333 by July 23rd, the trader will collect the entire premium collected from the trade. And this is the goal here, reducing the risk, maximizing the gain. What about the trade for the ticker UPST? This is for a company called Upstart Holdings, and it has been involved in this meme trade, and somebody's bidding for more gains to come. They bought the 130 calls, expiration date August 20th, with expectations that the name will rise by over 8% by then, and they paid about $10 a piece to enter this trade. All in all, bringing the total to about $5 million. What about the trade for the ticker SAVA? This is for a company called Cassava Pharmaceutical Therapeutics, whatever it is. But the name was down big on Friday, and somebody's betting for more pain to come for this name because they're buying the $90 puts, expiration date July 16th, meaning this upcoming Friday. And they are expecting the name to drop by over 5.5% by then, and they paid about $5 a piece to enter this trade. All in all, bringing the total to about $2 million. Lastly, what about the trade for the ticker NEWG? This is for Newegg, in case you missed college. They're betting for gains to come here for this name by buying the $50 calls, expiration date July 16th, meaning this upcoming Friday. And they're expecting the name to rise higher by over 7% by then. They paid about $5.50 a piece to enter this trade. All in all, bringing the total to about $1.5 million. Moving on to the heat map analysis. This is the heat map for Friday. Everything is lighting up green, but led by the inflationary trade of financials, energy, industrials, and materials, but specifically financials. And the reason is we were predicting a bottom in yields popping higher, helping all of these financials to rise higher. Mind you, we have banks' earnings starting this upcoming week. So once again, combine the bottoming process in yields with some short covering, and you get a massive bounce in banks, specifically regional banks. And you're seeing the bounces in Chinese names too: Alibaba, Pinduoduo, JD, all outperforming on Friday due to a lot of short covering. And therefore, when we talk about the sustainability of the technical bounce, because the US dollar reversed to the downside, gold stayed flat, yields popping higher again, bottoming, is it sustainable or not? Perhaps for certain sectors of the market, assuming that the inflationary data comes out supportive, but for certain names, the bounce could not be sustainable if they're happening due to short covering. That could be happening in the Chinese names like Alibaba, JD, Pinduoduo. So be careful here because the sustainability of the bounce in these names are under question. But we also saw the tech sector of the market, the high multiple names, also outperforming. So Friday acted as the tide that lifted all boats. Once again, yields bottoming and rebounding higher, that is helping the inflationary trade, but it is not hurting technology and the high growth, high momentum names. The reason is yields are still low, 1.3, 1.4, all the way to 1.5. No problem at all for the tech sector of the market. The problem starts when we get to 1.6, 1.7, then tech starts to get nervous. Now let's contrast this with the weekly heat map. Right away, yields have been getting crushed throughout the week. What does that mean? It means the inflationary trade also getting crushed, whether we're talking about financials, energy, industrials, materials, all getting whacked this week. However, the interesting take for the week is the following. The other pole of the market, the tech, high growth, high momentum names, did not outperform altogether. You look at names, for example, like Tesla, Airbnb, Snapchat, down over 9% for the week. Even the semiconductor names, AMD down about 4.5% for the week. Micron down over 9%. AMAT down big. Palantir getting whacked this week. But the names that carried the Nasdaq to close in the green for the week were pretty much Apple and Amazon. And we know the story of Apple and Amazon. These are gamma squeezes led by the options market. Part speculation and part fundamentals regarding the Jedi contract, at least for Amazon. But watch out for the stealth rally in healthcare because we saw significant gains for names like Johnson & Johnson, Eli Lilly, AbbVie. All of these names managed to outperform the market in general this week. Therefore, healthcare is a safe spot to park some money if you are still uncertain of the direction of the market. Likewise, another quiet stealth rally in real estate. We saw gains across the board with very few exceptions in the real estate sector of the market. Again, another safe spot to park some cash amidst the confusion and the uncertainty. What about the ETF heat map? This is from Friday, lighting up green for the most part, led by the inflationary trade, XLF, KRE, these are the financial ETFs, XLE, XOP, these are the energy ETFs, industrials, the XLI, metals, XME, XLB, consumer cyclicals, XRT. So the inflationary trade was outperforming on Friday. Likewise, we saw some gains in tech, but it did not come from the XLK, the pure tech ETF. It came from semiconductor ETFs, likes of the SOXX, SMH, and SOXL. Remember, chips are in many ways an offensive trade, meaning you buy chips if you are anticipating a high growth, re-inflationary stage of the economy. Now, notice that the Chinese ETFs, the likes of FXI, MCHI, also rebounded significantly higher on Friday. But when we contrast the heat map from Friday with the weekly heat map, the picture is pretty much 180. The bulk of the pain came from the inflationary trade of financials, energy, and you see the Chinese ETFs getting absolutely hammered throughout the week. And the reason why I'm showing you the contrast between the weekly heat map and Friday's heat map is when you ask me about the sustainability of the bounce. Oh, Maverick, you said on Wednesday the market is showing bearish signals, and then on Thursday you said the market will rebound because yields are bottoming. What are you saying here? Is the rebound sustainable? Well, to answer that question, you have to look at this heat map and ask the question, was the action we saw on Friday a mere short covering? And if that is the case, then the sustainability of the rebound is in question. But if it is due to yields bottoming and rebounding higher because Delta fears were answered by another Pfizer booster shot, and the market shifting the focus from technicals to inflation data this week, if that is the case, then perhaps the rebound is more sustainable, at least in the inflationary trade. Moving on to charts, what's going on here, starting with the SPY 30 minutes chart. We have yet what it appears to be a bear trap in the SPY. We saw the first one during quad witching, and then we're seeing another one here where we see a gap down followed by a massive gap higher where the SPY not only recovered the drop but managed to close at all-time highs. So once again, the S&P 500 looks a lot healthier than the Nasdaq, and the reason is the SPY could give a rat's ass whether it is the reinflationary or disinflationary trade leading the market. The SPY benefits either way. Therefore, the resiliency of the SPY is a lot stronger than the Qs. Now, is there technical damage? Yes, there is. The trend that started from the last bear trap is over. But that doesn't mean that another trend will not be built and the SPY will continue to grind higher. Because when you switch to the daily chart of the continuous contract for the SPY, there's pretty much no technical damage done at all. The momentum indicators remain positive and they have plenty of room to go higher. The volume, yes, it accelerated higher to the downside. This remains the only warning signal for the SPY, the S&P 500. But beside that, we don't have any major signs for alarm or any reversal signal from a daily chart perspective in the SPY. Now, let's contrast this picture with the Qs, the Nasdaq 30 minutes chart. We had the bear flag topping pattern, followed by a massive gap down of about 1.5%. In the process of gapping down, the Qs managed to close a previous gap. From that point on, the Qs caught support and managed to go all the way, closing the gap down from Thursday and recapturing 360.5 for support once again. Is this bullish or bearish? It is bullish behavior because it shows resiliency and strength for the Nasdaq. But you have to remember, we have broken the trend. The positive trend is broken. All what the Qs has done is going back to the point where it reversed to the downside. And we have negative divergence on the RSI, at least from a 30 minutes perspective. So once again, when you pin the Qs with the SPY, the Qs is the weaker chart. What about the daily chart for the continuous contract of the Nasdaq? Once again, is there significant technical damage on the daily chart for the Qs? Not at all. Still holding, still above the support levels. But the difference is between the continuous contract of the Nasdaq and the SPY is the fact that the momentum indicators are more extended and they are more primed for a pullback than the SPY. So we're starting to see signs of cracks here in the Nasdaq. Perhaps if we get more inflation data signaling that inflation is rising higher beyond the transitory argument, then the Nasdaq will flush down significantly to the downside, perhaps breaking the support of 14,000. And the action we saw on Thursday was the warning signal. It's a crack for now. It's not a reversal. It's not a significant damage from a chart's candlestick pattern. It is just a warning signal. What about the IWM? What's going on here? 30 minutes chart, catching the support of 218 and gapping higher after that to capture 223 for support. Right now, the IWM is facing resistance. This is a zone where there is a chance for consolidation, at least for now. There are no gaps to fill on the way higher. So the only number we can look at is 229. This is the next resistance level. And the IWM is eyeing that level for support once again. But this will be a more difficult job than most expect, because you have the 227, which acted as resistance before. It will act as resistance this time around. And before the IWM reaches 229, it has to defeat 227 first. We have a gap on the way down where the IWM can go down, fill that gap, and then take it from there. But for now, I believe that the 218 support level is solid and should hold at least for a week or so. In addition, we're seeing a reversal in the travel names, the reopening names, airlines, casinos, etc., in addition to meme stocks holding, at least AMC. And if this dynamic continues, it will be good for the IWM to rise higher. What about the Dixie, the dollar index? We talked about a reversal. We're smelling the reversal. We're feeling the reversal. But we don't have a solid indicator yet. We don't have a solid signal that the Dixie has reversed until now, because the momentum indicators are reversing to the downside. But the ultimate confirmation for a reversal will be violating the support level of 92. And this could happen, by the way, overnight, as I'm speaking right now. The point is, the rally in the US dollar has gotten extended, and it is time for at least a pause in the pop higher, if not a reversal. If that is the case, then we are seeing a bullish road being paved for commodities, but specifically metals, to rise higher. In particular, copper, but not limited to copper. Gold could also participate in the rally if the US dollar continues to go down. Gold flattening at this point. There is no bearish signal that the rebound is over yet. Matter of fact, the momentum indicators are in positive divergence, and they are strengthening. But remember, gold has two enemies, the US dollar and yields. If the US dollar goes down and yields climb higher, that will kind of muff the potential for a rally in gold. Therefore, I still like copper better than gold. And here it is, the 10-year yield. We were eyeing 1.28%, 1.28 basis points as the line in the sand that has to be defended by the end of the week, and yields did exactly that, closing at around 1.36 basis point. Now, the sustainability of the rebound in yields will come under a lot of scrutiny this week. From a technical perspective, the zone of 1.4 to 1.45 is a resistance zone. Will this bounce? If it continues, will face significant resistance. In addition, we have a slew of macroeconomics data. And if we see softening in the CPI, the PPI, this bounce in yields will not be sustainable. And therefore, folks, once again, this upcoming week, we will start to shift away from technicals back to the fundamentals. And here it is, the TLT weekly chart. You want to talk about technicals? Here it is. The TLT stopping at my number of about 149 and reversing to the downside. Now, the weekly momentum indicators have a lot of juice left for the TLT to rise higher, but we talked about the contrast between the weekly and the daily charts. The weekly momentum indicators have a lot of room to go higher, but the daily are getting overextended, and therefore you saw the reversal on Friday topping at about 149. The expectations are the setup is favoring yields to go higher and the TLT to go down. On one hand, we have the technical reversal for yields and for the TLT for that matter. They're both inverse picture of one another. TLT topping at about 49, reversing, yields bottoming at about 1.25 and reversing. Now it comes to the fundamentals once again. The inflation data will dictate what will happen in the bonds market. What about the VIX? What's going on here? We talked about the pop in the VIX of over 42%. Failing to close the week above 20. And I mentioned that the likelihood is that the VIX on Friday will go down. Indeed, it did, closing the gap, and now we have red impressions on the histogram on the MACD. This is the 4 hours perspective. The likelihood is the VIX will continue to go down, at least on Monday, to close the other gap at around 15. And that could be yet another bottom at the same level. We have a quadruple bottom, and we will take it from there. But the prop is over, at least from a MACD perspective. It took us about 43% higher, and now it fades away, awaiting the next pop. What about Apple? What's going on here? 30 minutes chart. Gapping down, facing the resistance of all-time highs, and I cautioned against assuming that this is the reversal for Apple, or for the NASDAQ for that matter, because the gap hasn't been closed, yes, but we did not see a reversal after failing to close the gap. The chart just needed more time to gather the energy and close the gap, and this is exactly what it did on Friday. We have a bull flag formation around the all-time highs, and the likelihood is, when you hear the headline, Apple is trading at all-time highs again, Apple is breaking the consolidation, the likelihood is the trade gathers more steam. But as the trade gathers more steam, remember, the early entrants to the trade also start to book profits because Apple has been rallying in stealth mode for weeks now. Some people spotted that ahead of time and they're sitting on significant gains, whether there's stock gains or call options gains. And as we head closer to earnings, those gains will be booked. So pay attention here and be careful of being the Johnny-come-lately chasing the trade after the majority of gains already been made. What about Tesla, the souffle? What's going on here? We talked about the failure of closing above 679. That was followed by a double bear flag formation right after failing the next support level of 657. And that took the chart all the way down to the next support level of 629. That was good enough, so 679, tough resistance. That was a no-go. Okay, the chart goes down to the next support level to see if there is energy, because you need new blood to hop on the trade to break above 679. And when the chart went down to 657, there was no energy there. There were no buyers. That was not good enough. So the chart went down all the way to 629. At 629, there were buyers hopping on the trade. Will they stay all the way for Tesla to reattempt to recapture 679? That remains the question. Now, there has been a lot of talk regarding the so-called death cross in the souffle, where the moving averages cross in a negative way. And that is usually an indicator that the stock will flush down, and it is looked at as a bearish indicator for any given stock. Now, heed this warning because I used to program these algos. Yes, the algos are programmed to follow moving averages, but they usually react to these crossings in moving averages for that particular day. And then the algorithmic reaction goes out of the window. And therefore, I don't put a lot of stock on moving averages. I don't even show them in my technical analysis. They mean nothing to me. They're important for the algos, granted. But the algos react for a day or two max to these milestones and moving averages. And then it's all up for grabs. So I take the so-called death cross with a grain of salt. Is there technical damage in the souffle's chart? Yes, there is, because 657 remains resistance. If the souffle fails once again to break above 657 and we see a reversal, the likelihood is that 629 will not be good enough. And that will be a signal to short Tesla or to double down on the shorts. So watch 657 extremely closely. What about tulips? No update here, still consolidating. This is the chart from last night, so there is a little update. BTC is trading a little over 1%, but nothing technically significant at all. If this consolidation continues, the likelihood is the bear flag will play out and 30,000 will be violated. I keep talking about 35,750, but the laser beams so far are failing to reach even that small milestone of closing above 35,750 on weekly basis. So if this small goal, easy to reach goal is becoming tough for BTC's chart to reach, then we have significant weakness in the momentum for Bitcoin, and therefore the likelihood of violating 30,000 becomes more likely. Lastly, what about AMC 1 hour chart? We talked about the bull flag formation. It is still here, and we have a series of lower lows. The question is, are we going to start to reverse this negative trend, creating higher lows? This is what I'm watching for. Yes, the gamma squeeze did not happen on Friday, but is it over yet for the apes? Not really, because the bull flag is still here. The momentum is still here. But at the end of the day, this is an options market story, and we are reaching an important milestone. An important deadline, options expiration for July. Market makers still have the power in this chart because retail already all in. They're all hodling, they're all with diamond hands refusing to sell. So it all comes to the hands of market makers. Are they going to buy AMC shares by July's expiration, or are they going to start selling AMC shares by July's expiration? The answer is, were the contracts already closed, or are they still open to force market makers to buy the stock? You have to study the options grid. I don't have the time to do it for you because I could give a shit about AMC, but some of you apes have to do that homework. Study the options grid and study the open interest for these contracts near the money with the expiration date of this upcoming week. And study how the changes happen throughout the last few weeks. Is the open interest increasing or decreasing? And this will give you the answer of what market makers will do this upcoming week. Anyhow, we're moving on to the conclusion of this video. What do we have on the economic calendar this week? Remember, we're shifting from the technicals back to the fundamentals, back to the news, back to the economic calendar. And boy, we have a lot of important inputs coming out for the market. We have nothing tomorrow, but Tuesday, July 13th, we have the CPI and core CPI. This will be extremely important. You don't need me to stress that importance, because you already know, and we will talk about the components of the CPI and my expectations for the number in tomorrow's video. Wednesday, July 14th, we have the Producer Price Index, the PPI, and in my opinion, the PPI is more important than the CPI. Then Thursday, July 15th, we have, per usual, the initial jobless claims, and then we have the Import Price Index, the Empire State Index, and the Philly Fit Index. This is inflation extravaganza. Economists all over the world are looking at this calendar with a big jar of lotion on the table. Lastly, on Friday, July 16th, we have retail sales, the Consumer Sentiment Index, and business inventories. All eyes are back on inflation. That is the message. Anyhow, that's all I got for you tonight, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.